Oh, you got to catch your breath here. We're trying to bring on people who really have a more breadth of experience than a lot of people because it's an important day. It's the day where the Dow had its worst performance since February, dropped 832 points. There's a lot going wrong at the moment, but the fundamental issue is that Wall Street's worried about a Fed-mandated slowdown. One of the places we're seeing that is in construction and lending. When interest rates go up, you tend to get a slowdown in these two areas. I think that's what we're seeing. There's a lot more to it. I want to check in with a real estate investment trust that has its finger on the pulse of these industries, Starwood Capital, privately held parent of Starwood Property Trust, STWD. Wow, this stock's been slammed. It's got a 9.2% yield. It makes no sense to me whatsoever. This is value. But Starwood Capital has some particular issues that we got to talk about and some great insights because they just don't own real estate. Main business is actually financing. They lend and invest in all sorts of properties, which means they're perfectly poised to tell us about the state of the industry, even turbines. So let's dig deeper with Barry Sternlicht. He's the chairman and CEO of Starwood Capital Group, who's one of the top experts in the field, get a better sense of how the real estate world is doing and how the lending world is doing. Mr. Sternlicht, what a delight to have you on a day like today. Barry, have a seat. Well, we're very lucky because I think you know more markets than pretty much anybody that are important and are on the line right now. And your conference calls are brutal because of the humility you show and how hard you are on yourself. You've got a company that I think has more than enough coverage to have a 9% yield. Makes no sense to me. And in this environment, rising rates, tell people why it's compelling value, because I sure think so after I've read through all the decks.
And the day the Dow's down 832 points, you'd like to earn a 9% dividend yield. Actually, it's interesting. We started the company in 2009, and today it's the largest in the country. Right. It's got a $15 billion asset base and is very diversified. So we have a very safe dividend yield. In fact, as you mentioned, we're a lender. We own assets also, but we're the largest commercial lender that's not a bank affiliate in the United States at the moment that's publicly traded. And we have like 62% LTV. So property values can fall 40% before we have any impairment to our loans.
Well, that's important because someone asked me today, is this like 2007?
No.
And I said the loan to value, but I was thinking of your company because you're pretty secure in what you lend.
Yeah, 62% loan to value. If we were, I was asking one of my guys today, I said, if we were just a $7 billion loan book, and we were, what would you be able to finance that package, 62% LTV? They said that would be like 1 3/4 over LIBOR, like 3.5%. We pay you 9%.
Right.
But supporting that, about a quarter of the book is actually fee assets. We own apartments. We own low-income apartments, financed for 17 years with fixed-rate debt, so there's no risk of refinancing, and they're earning like a 14 yield cash-on-cash return. We have like a $200 or $300 million embedded gain in our equity book. So that's a couple dollars a share on top of the book value. So we've actually never understood why the stock trades here. What's interesting to me is the equity market trades us like we're going out of business.
The bond market
which
loves us. And the bond market is historically
the credit guys are the
smartest
guys.
Because they do much more work.
They
now,
do
one of
much
the things
more
that, but you also have a lot of insight in terms of what's going on with the government.
Yep.
You actually mentioned in that most recent conference call that you said that steel has gotten so high that it's almost like it's not worth it to build. That's something that people don't understand, including perhaps our Fed chairman.
Well, construction costs are rising for both commodities and labor, right? And labor is scarce. The housing market's taking on the chin, right? Between mortgage rates and the cost of construction, that you see starts coming down. Look at a 62% LTV. The V is based on the value of the assets. If it costs more to replace, the actual V is going down.
Right. See, this is what but maybe the Fed doesn't seem to know that. Yep. It's almost as they think that it's still going like this. But in your conference call, you make it very clear that values have peaked in a lot of areas.
Actually, we don't think so.
No, but you did you said in Manhattan.
Oh, okay, that's true. In high-end residential,
I should be more specific. High-end residential, you're
apartments on both coasts in the big blue cities of New York, San Francisco, even Seattle. Rents in the A stuff are coming down.
Right, that's what.
But we don't actually, our exposure as a lender is mostly office, 32% office, and that's actually done pretty well across the country. And the other thing is the book is all floating. So if rates go up, I think we get hit. With the residential REITs, where they have a mismatched book, they have lend long and they finance short. We don't do that. We are match funded and we're all floating. So if rates go up, we actually make more money.
And that's important for people to understand that a lot of REITs are the opposite when they get hurt. Now, Eddie Lampert. Looks like they're filing bankruptcy at last. You are no stranger to the shopping malls. The shopping malls. You talk about how, look, it takes a little while to get a Dave & Buster's in there, but you need to have anchors that people go to. Yeah. Is this a positive or negative for the mall world that company could be bankrupt?
Probably a net positive.
Wow.
So in our malls that we own, we don't have a large one. Nothing. With 3% of the assets of the property trust are in malls or retail. They're not even in malls. But in our private business, we have some we own some malls. The income that comes near the Sears store is 3% of the mall's income.
Right.
Nobody wants to be in front of the Sears because there's nobody in the Sears.
Right.
So
Right.
we take it back and make it an apartment building or a David Buster's or a Kidzania or one of the other, or a theater. So honestly, I mean, it's good for the owners to get on with this.
Right.
And we'll see what happens with Penny's too. But interestingly, they will reorganize.
Right.
And a lot of our stores, even Sears stores, doing $30 million. They'll just chuck out the bad ones, and then they'll use this as an opportunity to rescale their company and try to restructure their debt and get some. Yeah, the way capitalism works.
Right. Now, let me
you're
ask
from
you.
New England, right? We had Caldors. We've had.
Oh my God, Ames, Bradleys. I mean, we didn't go to those. Exactly. That's capitalism.
Right.
Now, any words of wisdom to Fed Chairman Powell, whom I know does watch the show?
What people understand about the tariffs is you're going to see their impact, I think, in the first quarter of next year, right? Because the inventory was here, it's on the shelves, it's in the warehouse, it was bought without the tariff. Right. So you're going to have a latent inflation pressure in the market, which the Chinese are trying to deflate by knocking their currency down, which Mnuchin said yesterday, don't do that.
Right.
Doesn't mean they won't continue to do it. So they knock the currency down 25 and 25% tariffs. It's flat, right, to the consumer here. But I think the Fed is going to have to be careful. The economy is not quite as strong as the number indicated. And
okay, can I just say, I feel it's only you and me.
That's probably right.
But we're right.
Yeah. That was soybeans and commodity restocking, 4.7.
You and I are right.
Yeah.
And this idea that this economy is red hot is rearview mirror.
Yeah, I've been in a couple of investment conferences where the yield curve really bothers me. The fact that you can borrow 2 years and 30 years, pretty much, it's flat, right? It's flat.
Yeah, that's not what we're used to.
No, it's not what we're used to, but usually it's a signal of a downturn. I think it is a signal of a downturn. People think if rates go up too high in the short end, there's competition for capital, and the economy will roll over. So sadly, there's another problem you have, the $300 billion stimulus package that they passed on top of the tax bill. They're not going to be able to do that again next year.
No.
So you're going to lap against
year over year.
It's going to be tough.
Thank you. I just needed to hear that. I mean, I love people saying, listen, they got to put the foot on the brake. I think you and I got a little more expansive view. Maybe we're just getting a little older.
Experience.
Well,
I don't call it old.
Okay, I like that. That's Barry Sternlicht, Starwood Capital Group Chairman and CEO of Fed Chairman Powell. I think you should listen. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.